We are looking at a chart of gold daily time frame to see if we can kind of determine where we might be headed. And my process is very simple. I don't overcomplicate the process because at the end of the day, the market is going to do what the market's going to do. You can't control that. Okay. So my process always is, where have we come from? And the market, as I said, only does one of two things. It's either reaching for liquidity, which is buy stops or sell stops, or reaching to an inefficiency to rebalance the market. So if I look down here, okay, where's the market coming from? That's the first question I ask myself. I can see that we are coming from a place where we have taken liquidity. Okay, so this move down has taken out stops. Okay, anyone that was long, they've now been stopped out potentially. Okay, so that's liquidity, and therefore that objective on this move down has been met. Okay, so now the market's turning around. We're clearly going higher. So we have now come in to a level of inefficiency that has now been balanced, right? So after taking liquidity down here earlier this month, the market has moved up to rebalance. Okay, so that objective has been met. Now, I then look for potential support areas, and I don't use the typical support and resistance concepts. I look for down candles that the market is showing to support a move higher. Okay, so I see this big down candle because my eyes always gravitate to these big candles because they are driven by institutions, by the people who control these markets. Okay, and if I look at that, when the market trades above the high of those down candles, that's important. Now, when I see two consecutive candles like this, I just make that into one. My eye just classes that as one candle. So that is two down candles. I just join them together visually, right? So I just put that on top of there, and that to me is one candle, okay? So to me, that's just one down candle. We've gone above the high of that and closed above the high. That's important. It's not just a wick. It's not just a wick and back down. We've actually closed these green candles have actually closed above that, okay? To me, that big, what I'm now just saying is one candle, should act as support when we come back down into it. So I am going to put, I'm just going to mark out the open because I can see that we've already come down to the open of that. Okay. And so we've gone up. Okay. And as expected, we've reacted from this area because that's a balance. That's now inefficient. We'll come back up to rebalance that inefficiency. Expected reaction there. Move down back to support. What I call support. Okay. How I read that as a support. I read that as a pullback, right? Let's draw an arrow. So I see this. Okay, pullback into an important price point. And then my expectation is continuation. Why? Because number one, understanding what the market is doing. So you've got to understand something that many people don't realize is that when I see this, okay, we've taken liquidity and we turn around, there's a clear turnaround there, okay, I'm already looking at these highs and thinking that's where we're headed for a couple of reasons. One, they're huge wicks that the market needs to come back and trade into, and those highs are very close together, okay, which is referred to in the industry as equal highs or relatively equal highs, okay. So there's a lot of liquidity resting above that, okay. Now on the way up there, we're going to hit speed bumps, okay. So what's a speed bump? Well, an expected speed bump is where we are right now at this level. Why is that? Let me get a square. Why is that a speed bump? Because I'm expecting a reaction from that level, okay. And so we hit a speed bump, and then we start going down, which is that down candle. We hit another speed bump on the way down now, which is that level there, because I'm expecting that those two down candles to hold price, right? To hold price at that level. That's basically support. Okay, that's how I view that as support. Now, each one of these is a speed bump. It doesn't mean it's a complete turnaround, not a complete reversal. Okay, it's just a speed bump, right? That may slow you down a little bit until you reach a point that will support a move to continue in the higher objective, which is to take this liquidity resting above. So that's how I see this market as it stands right now. I see higher prices. Now, what I will do is I will look at where are these gaps in the market. Where are some, for example, is there a need to come down from where we are? And when I see this, I think because we've only had buy price delivery, perhaps there's a need to come down here, but we need to do some further analysis. So what I'll do is first thing I'll do is I'll try and measure where's the midpoint of that inefficiency, which we have come into, okay? And then I'll look to the left and see why have we come up through there? What's here on the left? I see that price has had sell side delivery, okay, on this big down candle that's on end of April. And now we've had buy price delivery through and back up that down candle. And so to me, we've gone down and come back up through there, which has essentially balanced that down move with this up move. And we've also then come back down to balance this part of the up move. And now we've gone back up. Okay. So to me, this entire area is balanced up to where I've drawn this dashed red line and where we've come straight back down into and gone back up. Okay. What right now, in my view, is not balanced is this portion here. We've got this down price delivery. We've gone back up into it and come back down. Okay. But now we have this wick that, in my view, from my perspective, is currently a level of inefficiency that we, in my view, need to go back up into. Okay. And if we just measure that, what is that? About 60 pips, I think, if I'm measuring that correctly. It's not getting anchored right. But anyway, whatever that amount of pips is, it's irrelevant. So I look at that with all the things that I've discussed and form a prognosis that, based on the fact that we've gone down to rebalance this whole area here, coming to these two down candles, which in my view should act as support, and then had a reaction, that we are headed back up to at least this level, which is 2373. Okay. And that's not too far away from where price is right now. Price at the moment is at 2357. So it's only another, another 100 pips or so, a bit more than 100 pips, back up to 2373. Okay. And then perhaps continuation up to at least this liquidity, and then maybe the higher equal relative highs. Now that all doesn't mean we're going to get there in one day. That might take a couple of days, might take a whole month. Right? We might have a retracement back down before we move up, or I could be completely wrong. Okay, there's no guarantees in what the market's going to do. I do think that in the interim, there are these highs that are pretty close together that the market, in my view, should be reaching for. Okay, so if we look at 2388 or thereabouts, that would be kind of where my eye goes to. Okay, or 2380, just rounding that up from 2378.50, going up to 2380 from where we are now. Okay, now none of this is guaranteed. Anything can happen in the market in the current geopolitical climate that we are living in. At any point, we might have an event that completely changes the current market structure, and obviously nobody can predict those kinds of geopolitical events that may shift market sentiment immediately. So you always need to have that in your mind and manage your risk. You can't expect, no matter how much analysis you do and how many things are on your side, and even if the mathematics is working out, you cannot treat the market as a guarantee. Okay, you always need to have in the back of your mind that anything can happen. So this video was just about a quick discussion on how I analyze a particular market on a higher time frame, such as a daily. Then I would normally go back and look at it on this on a weekly and a monthly to kind of ensure that my analysis here on the daily is in line with the weekly and monthly timeframes. And then I would look at the shorter timeframes like the hourly, 4 hourly, and 15 minutes intraday. Okay, so I hope that this was insightful. I don't overcomplicate it. That's as simple as I keep it, right? I don't go into any more details as what I've explained on this video when I am analyzing a market to determine directional bias. You do have to have a narrative. You need to have a directional bias so that you can trade or forecast future price movement that is in line with the higher time frame direction. Okay, I will now talk with you in a future video.